We've taken the time to figure out our costs and our benefits, and now what we're going to do is we're going to translate that cash flow that we came up with to the idea of strategic value. And we're going to go through a series of steps to calculate strategic value. And the best way to characterize strategic value is by return on investment. Return on investment is probably the most important number in ICT. Return on investment, you obviously want it to be a positive. You want it to be 100%. You want to be able to get your money back, your initial investment back, and actually generate some sort of incremental benefit on top of that. You want to earn a return. Otherwise, it wouldn't make sense to actually do the project. But there is a complicating factor that enters into the equation here, and that is that money has a time value to it. And think about it this way. Which would you rather have? $1 today or $1 a year from now? Well, let's make this a little bit more interesting. Which would you rather have? $1 million today or $1 million a year from now? Well, think about it for a second. Hopefully arrived at the answer that you'd rather have $1 million today. Why? Because if nothing else, you could take that $1 million, put it in a bank, and even at today's paltry interest rates, a year from now, you would end up having more than $1 million. You'd be able to earn a return on that $1 million. Anytime you're looking at benefits out in the future, you have to understand that those dollars out in the future are actually worth less than the money that you have today. And the way in which we calculate that factor by which we determine that those future dollars are worth less than the dollars today, is through a term called a discount rate. So what we do is we essentially take future dollars, future revenue, future benefit, future gains, and we discount them back to today's dollars. So that $1 million that you would earn a year from now is really worth less in today's dollars than $1 million. Again, money has a time value to it. You'd rather have money today than money tomorrow or money a year from now, or that same amount of money a year from now, because you can use that value, invest it, and earn a return. And that foregone return is, quote, the discount rate. This idea of a discount rate is a bit tricky. I'm going to attempt to explain this so that you can understand, because it's maybe not as straightforward as you might think. A discount rate is expressed as a percentage, and it often gets confused with an interest rate or even a cost of capital. Now, for those of you who have a finance or a business background, these terms may be familiar. They are similar, but they are not exactly the same. So I'll take these in turn. An interest rate is a finance charge. It is the percent that's applied for a loan or what you might earn from a bank. And an interest rate is something that we're all pretty familiar with. Anyone that has a house or credit cards or a car loan, we all borrow money. We incur a finance charge, an interest rate, a percentage of that principal that we borrowed as a fee we pay back to whomever we borrowed that money from. And that's an interest rate. And that enters into the discount rate, that idea of having to actually pay a finance charge for the use of money enters into the whole notion of the discount rate, but it's not quite that simple. The next level is a term called the cost of capital. A business goes out and borrows money or raises funds from a number of different sources for its projects. It can go and actually borrow money, get a loan, much like we do when we buy a house or buy a car, and those are called bonds. And you can go to the bond market, issue bonds, borrow money, and you'll be charged an interest rate on those bonds for the use of that money for however long you need it for that particular project. The other thing you could do is you could go to the stock market and you could raise money by issuing stock. Investors will require a return for their investment, again, expressed as a percentage, whether it's in terms of a dividend or in growth, there is an expectation that that stock will increase in value by a certain percentage. And that certain percentage, akin to an interest rate, but not really, it is factored in. That percentage return on investment is entered into the whole notion of the cost of capital. And then there are internal earnings. The cash that the firm generates can also be used to fund projects. Each of these have a separate cost or a separate implicit finance charge, if you will. Bonds have the lowest. Why? Because bondholders always get paid first. Bondholders not only get paid based on the principal, but their bonds are secured by the assets of the company. So if a company is unable to repay its bondholders, then those bondholders can actually take action against the company, force the company to liquidate assets so that they in fact get paid. So the risk level on bonds is relatively low. Stockholders, on the other hand, are at the other end of the spectrum. They get paid last. They are the owners of the company. Everyone else to whom the company owes money, whether it's employees or suppliers or bondholders, whomever that might be, they all get paid first before stockholders get paid. And so they incur the highest amount of risk, and therefore they would expect the highest return. If you're going to have more risk, you expect a higher rate of return. And then there's the internal earnings generated by the company that have an implicit finance charge, and that is that for any given project, if you use internal cash to fund that, that internal cash could in fact be applied to a different project. So there's an opportunity cost of using internally generated cash for one project over another, and that is the opportunity cost, and that too needs to be reflected in the calculation. So the cost of capital then is the weighted average of these sources of funding for a particular project. So it's called the weighted average cost of capital, WACC. You would weight the overall cost of capital, that finance fee, based on the proportion of the money that you raised for that project from bonds, from stock, or from internally generated earnings. And that's, in its simplest form, a description of the weighted average cost of capital. If you were to go to the finance department over at the Daniels School of Business, they give you a lot more complicated explanation than that. But for our purposes, cost of capital is the weighted average cost of capital between bond, stock, and internally generated earnings. Then there is the discount rate. So what we do is we then take the weighted average cost of capital and we add a risk premium to come up with the discount rate. And so what is this risk premium? So let's just say we computed that our weighted average cost of capital is 14%. Now, not all projects are created equal. Some projects are riskier than others. So depending on the risk, you need to tack on an additional percentage points in order to accommodate that risk. That is the risk premium. Let's explain this by an example. Let's say you're Google, and let's say you have a project which is to improve the search algorithm, something that Google's pretty used to doing. Therefore, there's a very low risk associated with this project. So the risk premium would be little, if any. And for our purposes, we'll say there's no risk premium attached to this. And if Google's weighted average cost of capital is 14%, then the discount rate for that particular project would be 14%. Now, let's say, though, that they're deciding to get into, for example, the driverless car business. Well, this is something that Google doesn't have a whole lot of experience with. It's a fairly new technology. There's a fair amount of risk of whether or not this will work or not. Therefore, we would have to tack on an additional couple of percentage points for the risk premium. What a discount rate is, you'll hear it also described as the risk-adjusted weighted average cost of capital, which means that for any given project, some evaluation of how risky it is would result in an additional finance charge, if you will, in order to come up with the discount rate. The more risk involved in the particular project, the higher the discount rate. And that's the theory of how to come up with the discount rate. I'm sure you're going to ask the question, well, how do I calculate the discount rate? Well, calculating the discount rate, as we have seen, is a fairly complex process, and it requires understanding the capital structure of the organization. And honestly, the easiest thing to do is to simply ask your corporate finance department what the weighted average cost of capital is. And that's typically what one would do in an ICT organization, is get that information from the finance department. For our purposes in this course, you will be provided a weighted average cost of capital so that you don't have to go through the mathematical gymnastics of trying to calculate one. So we're going to leave this discussion about the time value of money and discount rates here. We'll be using that number, the discount rate, in our calculations going forward.